So we're going to talk about loans, the second option I gave you. Fact is, loans are, and I'll just write this here, 99%. They fund 99%, 99.9 probably, percent of all businesses out there in regards to the company that you probably want to start if it's a service-based business. And I can tell you this, I mean, I set up Core Agents way back in the very beginning with a £10,000 business loan. Went to the bank. They had these startup business loans available. I qualified. I went and got this loan, and then I used that to create the website, and I put my little office together, my home office at the time together, got the computer that I needed and the peripherals that I needed to get started. And before you know it, I had a little bit of working capital to get the job done. And that's how I was able to fund myself, go out there and actually win business. So yes, if you're running a service company, if you're whatever type of business that you're running, loans can be a great way to get started, right? So that's an option for you. Don't think it's not an option, and that you should always be looking for an investor as in a person to come and put money in your business. You can just simply go to the bank, and believe me, they don't get the headlines like the VCs do. They don't get the headlines like the angel investors do. When you get this one very, very wealthy individual who puts money into a business, it hits the news in a big way. So like that, it's a demonstration of faith in that business. And of course that props those companies up. But the fact is, most businesses will just go to the bank and say, "Hey, Mr. Bank Manager, I need a loan. I need to buy, I'm a car dealership and I need to buy 10 new cars. So I need a loan to buy them. The collateral is the car itself, or maybe my business, and maybe I put up my home." The fact is, that is how a lot of companies get the stock that they need. They just get loans and then they have to sell against it. So, but there's obviously, as I'm pretty sure you're going to know, and as far as awareness is concerned, you'll have had credit cards, or at least are aware of credit cards and how they work, and any other kind of debt instrument, right? Because that's what this is. It's a debt instrument. And of course, there's many different types of ways, but as far as generalizing is concerned, what should you think about? Why should you do it first off? I think the first most important one is when you don't need too much money. I mentioned 10 grand as an example. 10,000 to 40,000, 50,000, I guess max 70. Okay, let's say max is 100,000. That could be a kind of a loan that you could take, to set a company up, operate the company. But bear in mind, you're going to have to, there is a repayment schedule here. Like every month, you're going to have to make a payment on that loan, right? So just bear that in mind. When you need it quickly, okay, you're not having to convince investors or multitudes of investors or go to board meetings or put together big pitch decks for them. You're going to the bank, and the bank will say, "Okay, what are you putting up as far as collateral is concerned? What's the value of it? What's this? Okay, so we can give you a loan of this much. Will that suffice?" And that's it. You get the loan, right? So it's not as easy as that, but I mean, that's the way it would go with a bank if you had some collateral. So when the operations depend on it would be, and let's go back to that example with the parking lot there, or the car sales company, in terms of them buying cars with debt that they needed to sell. I mean, that's operations. Or if you have operations in the sense that you've got big deals coming, like in real estate world, I know I've got a big deal coming. I've put all of my equity or my capital into that deal, as far as buying it, putting it off, taking it off market. I've created, I've created an equity raise to pull in investor money, and it's coming in. And as soon as it's done, we're going to flip the thing, whatever the case may be. But I have to carry myself and my organization, my marketing costs and whatnot. I can use a loan to cover my costs, knowing that there's going to be this payout later. So there's that there too. And of course, when there's no equity, remember I gave you that example in the equity example. If you have all these shares, you had 1 million shares, and you're either unwilling to portion some off, like you're unwilling to give out equity, and you're not equity raising, or you just don't want it, right? Then you can obviously go for a loan, because fact is, if there's nothing to share in the business, then you're going to have to just take a loan, because that's the only other way for you to actually get money. I mean, don't think that loans just come from banks. I mean, loans are anything like loan notes. Loan notes could also be going to other people and saying, "Hey, can you just loan me the money? And if you loan me the money, I'll just pay you this much money back." That's it. So that's a loan. So that's the reasons why you should do it. So it's not just the banks. It's people as well. but it's always specific in that there's payments to be made. And I think I'm going to cover that here. You'll always need collateral. Okay. There can be restrictions. Remember I mentioned this? This is your shares that you've available. You might be able to take a loan with a bank or an individual, a debt, essentially. They say, I want 50,000. And they'll say, okay, well, you can't, there might be restrictions or ratios that you have to maintain throughout the loan period, or they'll pull the money. For instance, they're going to want to know, that let's say you can't sell, say, more than 50% of your equity, while you have this loan. Okay. So while you have this loan, you cannot go over this. So there's restrictions as well. So once you take on this loan, it's like doing a deal with the devil, right? You have to like make sure that you abide by their rules, because if you don't, then you're immediately in a default situation and they can start pulling things on you. High interest rates. Yeah. You're going to pay them, 7%, 8%, could be more, could be up to 12%. I've seen some like private lending firms out there hitting you up on 20%. Like it's crazy. Like interest rates, you've got to be obviously pick and choose, but loans are a great way to get money in quickly. Collateral, assign it to some collateral. You're risking everything, but you can get it. But you're having to now pay high interest rates. You're risking a lot of things. And of course, how many times have you ever gone to a bank and asked for a credit card, right? If you look at this the smallest way, right? I want a credit card and I'm hoping to get 50 grand or 100 grand credit card or 20 grand credit card. I don't know where you are or where you're at. And you go in and then they offer you a $5,000 one. That's all your credit score will get you. Or you haven't got enough of a behavioral score, that one that goes on top of credit score, a behavioral score as far as the bank's concerned for you to be having this kind of card. So kind of works the same way when you're getting a loan for a business or working with a loan note. The lender, whether it's an individual organization or a financial institution, are going to say, well, okay, so you want 100 mil or you want, that's too much. They say you want 100,000. We're not willing to give you that. We give you, okay, you put your house up, you've got your business, you've got some collateral here. We'll give you 60,000 and we'll give it to you at 6% interest. And, this, that and the other as far as terms are concerned. So you might not get the amount you need, although you'll get some money in quickly. So that's the things to look out for as far as how you're going to take that first step with your business. Are you going to sell equity? Are you going to go straight for a loan? Or are you going to do what we're going to talk about in the next section here, which is a convertible debt, convertible note, where it's a mishmash or a hodgepodge or this kind of hybrid between a loan or a debt-based instrument and an equity-based instrument. So I'm going to just quickly go and run through that in the next section. So I'll see you there.